Hello, I'm Brent Joyce, Chief Investment Strategist at BMO Private Investment Counsel. It's Thursday, March the 28th, 2024. Welcome to our Global Markets Commentary. The first quarter of 2024 brought substantial equity market gains, with many markets up over 5% just on the year, and the list of markets clocking fresh all-time highs is getting longer. Fixed income logged a mildly negative quarter, giving back some of the outsized gains that closed off 2023. Not so surprising given the shifting macroeconomic narratives that we'll talk about. Major themes to kick off 2024 are a continuation of some oldies but goodies: inflation, economic growth, and central bank policy actions, but always with a side order of politics and geopolitics. However, many of the economic themes are looking better. Not so much for the politics or geopolitics. Inflation continues to trend favorably, albeit not uniformly across geographies. Very much worth celebrating that Canadian inflation for January and February saw the first back-to-back sub 3% readings in almost 3 years. Importantly, the inflation dynamics worrying central bankers today are related to wages and housing. I would describe these as less bad inflation versus the burden of higher food and higher energy prices. Wage growth puts money in people's wallets, boosting overall demand. Rising rents are a cost for one, but income for another. Both are essential price signals that should bring on greater supply of workers and houses, but this positive supply response takes time. We believe central banks are hinting that this less bad inflation is more tolerable, and considering the progress made to date, central banks aren't likely to go through the pain of a self-induced recession simply to squeeze out the last few ticks toward their 2% inflation targets. Where does this leave us for stocks? The most important factor for stocks is corporate earnings growth. Corporate earnings aren't just about economic growth. Costs and efficiency matter. Over the past 2 years, companies fearing the most called-for recession ever acted as if there was a recession, even though there wasn't. Corporations get lean in recessions, fake or real, as the animal spirits of capitalism are survival first and feast second. After 2 years of cost containment, adjusting to rising borrowing costs, recession fears, supply chain disruptions, corporations are poised to make hay, and the sun is coming out, solar eclipses aside. The future looks bright. Surveys of business outlooks, sentiment, and spending intentions are improving. With stable inflation and good profit margins, better economic growth will fuel earnings growth. Corporations are primed to shine. The equity market rally is broadening out to more corners of the earth and more segments of the market. A lot has been made that the S&P 500 is up about 26% since last October's low. What might surprise you is so are other major stock market indices, including Germany, Japan, and Taiwan. And it isn't just large companies either. The Russell 2000 US Small Cap Index is also in the plus 25% club. Canada remains a relative laggard, but the 18% return off the October low is nothing to scoff at. After these gains, there's a lot of talk that stocks aren't cheap. Given the positive backdrop, it is not reasonable to expect them to be. But they aren't as over their skis as some might think. Benchmark equity indices in Canada, Europe, China, an equal-weighted version of the S&P 500, and that Russell 2000 index of smaller U.S. companies, all trade below their 10-year average 12-month forward price-to-earnings ratios. We remind folks that equity markets can stumble. Experienced investors know stock market corrections in the 10% range, they generally occur every 8 to 18 months. After the substantial and uninterrupted gains since October, it would not be surprising to see some consolidation of recent gains. As for the U.S. equity market's outperformance and the sheer size of the U.S. market that some are calling U.S. exceptionalism, we call it global exceptionalism, which just happens to locate itself in one of the most favorable geographies available. The Magnificent Seven, Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, and Tesla, along with many, many more companies that make up the S&P 500. They're not just U.S. companies, they're global companies who choose to call the U.S. home. It isn't a coincidence that 4 of the 7 CEOs running the Magnificent Seven are non-U.S. born, 2 Indian, a Taiwanese, and a South African. The Zeitgeist at the opening of 2024 is one where consumer prices might still go up some, but way less than before, and people are getting raises. In those places where productivity is rising, it's especially strong in the US, higher wages aren't a problem. Globally, economic growth ranges from strong, like the US and India, to okay but improving, and certainly better than expected, most everywhere else. Stock prices can work with bond yields higher when it's more robust growth. The narrative has been bond yields stabilizing at moderate levels and stocks setting new records. Bond yields at current levels make sense to us and continue to deliver income. We do favor stocks over bonds as we remain constructive on the outlook for stocks with expectations that earnings growth delivers. That's the way we saw the first quarter and the month of March. Thank you for joining us. We look forward to you tuning in next month.